Welcome to the American economy. You guys had the essential questions for this section were what is GDP and how is it used, and how and why do people make economic choices. You should have used some of your prior knowledge about personal finance and how to save money to help you answer some of those questions, but you most likely had to go out and do research about GDP. If you would have done your research and you have a pretty strong base for this section, you should have your book pulled up on the computer, tablet, or printed out. You should be on page 485, it looks like. 482. 482 is the first page of the section. We have all 5 of our words there, which are product, gross domestic product, or GDP, entrepreneur, GDP per capita, and standard of living. You guys are responsible for getting those vocab words down, and throughout this section you will be using them in your own terms. Alright, let's get going. You guys will have 8 different sections in which you will need to take notes, and I will let you know when each of those sections are coming up, and you'll need to write down in your notes the name of that section I'm talking about and then any notes that you feel are important. Basically, if I'm talking, it's important. Alright, so let's get going. The first thing we're going to talk about is that GDP is important. Why is it important? Well, it's important because we're measuring goods or services. The first thing we're going to write down why GDP is important. And then we're talking about products. Products are things that you can touch. They are a shirt, a computer, a phone, a taco, if you will. All right. It's also they're also services, like you can have a car repaired, you can get a haircut, babysitting. You all know I worry about that all the time. All right, so that is why it's important. We are measuring everything that's in the United States. Everything that gets done is sold originally is for GDP. That's why it's important. The second heading you're going to write down is GDP measures total output. Basically, what GDP is, we look at everything sold for the first time within a year. Alright, so every time you go to the store and you pay for something and you pay tax. Anytime you go to an actual restaurant, a store, a car dealership, anytime you pay tax for something for the first time that thing is sold, that counts towards GDP. In 2010, the United States had a grand total GDP of $15 trillion. I have a nice graphic that you guys can look up as well, where it shows all that money stacked up. It would almost touch the top of the Statue of Liberty, and it's about as wide as 2 football fields. That's how much money. In 2010, China had the second largest economy of $9 trillion. So we were still about $6 trillion better than China. Go America. Alright. The third thing you guys are going to write down, header, is that GDP represents income. Basically, it measures income because when you buy something, you are supporting someone else as well. So if I buy a bike, we're going to be talking about a bike a lot. If you buy a bike, you are supporting that business. You're helping them with income. If you also not only helping that business, but you're also helping the factory worker that made the bike, you're giving them work, the company that supplied the factory with the steel, with the rubber, with the chains, everything. You're supplying a whole bunch of different people. So that's why spending money is important. That's why the government tries to encourage us to spend money, because we're helping other people with their income. All right, so now we know why it's important. We know that it measures income. Let's talk about the different factors of production, which is the fourth thing you guys are going to take notes about. Way back in the second quarter, we learned about the 3 types of resources used to make goods. We have natural resources, labor, and capital. So all those 3 kind of working together can make things. The fourth is entrepreneurs. An entrepreneur are risk-taking people who start and run a business. if you start your own business, you are officially an entrepreneur. And without these brave people, a lot of GDP doesn't happen. You know, when we think of businesses, we tend to think of Walmart and Chevrolet, Microsoft, Apple, these big companies, but they just make up a tiny portion of the businesses. The majority of America is entrepreneurs. They take risks. They invest their own money in a company. So we are measuring those different factors. When you are buying things, you're not only helping that business, and it's not just that little bit of stuff that goes into it, but we're also looking at we have to use the ground, we have to use water, we have to use labor to actually make the bikes, and we need capital like tools and a computer to help a CAD programmer make chains. So when you're spending money, you're helping these different businesses, a bunch of people you'll never meet. You'll help them actually make their money. All right. So the next thing you guys are gonna write down, number 5, is how do we measure GDP? This is going to be a big one. You guys are going to be doing some work with this. So how do we measure GDP? The simple thing we do is we look at everything that's sold, break it down into categories, and then multiply the average price of that item by how many sold. So let's say we make watches. All right, I sell my watch for $100, and I sell 10 of those in a year. That's my only business, my own little country, my little flag, Joeltonia. All right, I sell a watch. That's all I sell. My GDP will be $1,000 a year because that's what's sold. That's how we measure GDP. Your note you should probably write down is very simple. To measure GDP, you multiply every item sold by how much it's sold for. Then you take all these different items of a country and add them all together, all those different numbers, and that's how you get GDP. Well, then let's look at the next thing you guys are going to write down is what does GDP not include? That's the next heading. What does GDP not include? If you think back to when I first started this video, I said that GDP measures everything sold for the first time. GDP doesn't include if I were to take my cell phone, sell it to you for $50, stick that $50 in my pocket. That doesn't go into GDP because that's just a simple transaction. It doesn't count every year that you are paying on a car because you're paying money, you're paying a bank money every year. It doesn't count that. GDP only looks at the first time things are sold. You guys are going to be measuring GDP and creating maps and whatnot, and you'll be able to show me what GDP uses. All right. Let's talk about the 7th thing is GDP per capita. That's actually one of our vocabulary terms. GDP per capita is that what economists do is they want to see how much money each person in a country would get. That does not say we're going to get that money. That just shows how much money that country is making by how many people they have. How strong of an economy does it have? And all you're doing is you're taking the total amount of GDP. Like say in 2010, it was $15 trillion. So 15 and whatever many zeros that is. It's $15 trillion divided by how many people were in the United States at the time. And then it comes to be maybe $7,000, $8,000, $10,000 per person. If say you're in China and your GDP was 9 trillion, but you have like a billion people, that is far less, and that shows that their economy is indeed weaker. So GDP per capita is GDP divided by a number of people. That's how we measure GDP. All right. Last but not least, let's talk about standard of living. When we use standard of living, the definition is the material well-being of an individual, a group, or a nation as measured by how well its needs and wants are satisfied. What you guys should know, the last thing you're going to note is quality of life. Of course, the last thing you want to know is that economists aren't looking at GDP to, it's not a standard, we're not looking at how well we're living. We're just looking at based on how many people we have, how much our GDP is per person, how well are we living. Now let's say that if we were in China and our GDP was like $500,000, but there's a billion of us, our standard of living compared to other countries would be really, really poor because you wouldn't have a lot of money. But you could have a small country like Switzerland or Australia with not a lot of people. Maybe they get a boom one year and their GDP is through the roof. Well, then their people would have a nicer, higher standard of living than us. Standard of living is basically used for economists or people, maybe people wanting to move to a different part of the country, a different part of the world, to see how far their money would go. So that's what we need that for. So you guys are going to be looking over section 1 yourselves, reading, taking your notes, making sure your notes jazz up to what the book says, and you're going to do the lesson 1 review, which is there's 5 questions, and you guys will turn those in the next day. Peace.